Last quarter, one of the oldest companies in America sold more than it did a year ago. Its revenue went up. And then, in a single day, its stock lost about a quarter of its entire value, more than $50 billion gone. It was the company's worst day on the market since 1987. So how does a business that grew get punished like it's dying? The answer is a lesson every investor should learn once, and a twist almost nobody saw coming. The company is IBM, and here is exactly what happened. On Tuesday, July 14th, IBM did something companies almost never do. It put out its results early, ahead of schedule, to warn everyone the quarter had come up short. The preliminary numbers: revenue of about $17.2 billion, up roughly 1% from a year ago. That sounds fine, until you learn Wall Street had been expecting closer to $17.9 billion. So the business grew, but it grew less than promised. And these are IBM's own preliminary figures, released ahead of the full report on July 22nd. So treat them as a first draft, not the final word. When the market opened, the stock didn't dip. It fell off a cliff, dropping about a quarter of its value and erasing more than $50 billion before lunch. To understand why that reaction is so violent, you first have to understand who IBM actually is in 2026, because it's probably not who you think. Most people picture IBM as an old hardware company, big blue mainframes, the machines your bank ran on decades ago. And it is old. It traces back to 1911 and took the name International Business Machines in 1924. That makes it about 114 years old, the original blue-chip stock, the kind that's supposed to be boring and safe. But here's the part that's out of date. IBM doesn't make most of its money from hardware anymore. Its single biggest business is software, more than 40% of revenue, the single biggest slice of a company that pulled in about $63 billion in 2024. The mainframes are still there, but the engine is software and consulting, selling other companies the tools and expertise to run their technology. In fact, that reinvention is exactly why the stock had been climbing for years. Investors had started believing old Big Blue had finally turned into a modern software and AI company. Keep that in your head, because it's the whole game. When IBM warned about this quarter, the weakness wasn't in some dusty side business. It was in software and consulting, the core. And that raises an obvious question: just how bad was this drop really? Here's IBM's stock over the last several years. A long, steady climb, the picture of a comeback. And here's Tuesday. That single drop is the worst day IBM has had in almost 40 years. Watch where it lands when we stack it against the biggest one-day falls in the company's history. The only day that even compares is October 19th, 1987, a date traders just call Black Monday, when IBM fell about 24%. Two crashes, 39 years apart, almost exactly the same size. But now look closer, because the cause could not be more different. In 1987, IBM didn't fall alone. The entire stock market collapsed on the same day, the worst single day in Wall Street history. Everybody went down together. It was pure, system-wide panic. And 1987 wasn't about any single company. It was a market-wide chain reaction, where automated selling programs dumped stocks, which drove prices lower, which set off even more automated selling until the whole market spiraled together. Economists still argue over exactly what lit the fuse that morning, but not the shape of it. A system-wide machine feeding on itself, with nothing to do with IBM in particular. In 2026, the broad market barely moved. The rest of the market had a calm, ordinary Tuesday. IBM fell off a cliff essentially by itself. And that is the strange part. A market-wide crash you can shrug off as a bad mood, but this time, the market looked at IBM specifically and decided it was worth 24% less by dinner time. So what did that one memo actually say? This is the lesson, And it's the single most useful thing to understand about the stock market. A stock price is not a scoreboard of how a company did. It's a bet on what people expected it to do. Picture a student everyone assumes will bring home a perfect report card. They come home with mostly A's and one B. The grades are genuinely good, but the family had already planned the party for straight A's, so that single B lands like bad news. The student didn't fail. They just fell short of the story everyone had already written. That's IBM this quarter. IBM's revenue actually grew about 1%. Reality was basically fine. But the forecast said it should have grown more, and the company missed that forecast by under 4%. Under 4% short of expectations. And that tiny gap between what was promised and what showed up wiped out about a quarter of the company. The punishment was roughly 6 times the size of the actual miss. Because a share price isn't paying for last quarter, it's really the sum of every dollar of profit the company will ever make, shrunk down to what it's worth today. So when this quarter comes in soft, investors don't just mark down these 3 months. They quietly ask, wait, is next year going to disappoint too? And they reprice every one of those future quarters in a single afternoon. And here's what turned a small miss into a giant drop. IBM warned about the quarter, but did not hand over its full updated outlook. That doesn't come until July 22nd. So investors were left staring at a soft quarter and a foggy road ahead. And when the future suddenly gets blurry, the market tends to assume the worst version and sell first, ask questions later. That's why a company can grow and still crash. It didn't shrink, it just fell short of the story the market had already bought, and then left that story in doubt. But why did IBM fall short? And this is where the story gets genuinely ironic. IBM's CEO, Arvind Krishna, told investors that in the last few weeks of June, clients suddenly redirected their budgets. Instead of signing software and consulting deals, they rushed to buy servers, storage, and memory chips, the physical hardware that powers artificial intelligence. Why the sudden rush? Because the whole tech industry is racing to build AI data centers at the same time, and the factories that make the top-end chips and memory can only turn out so many. So the gear is rationed, prices keep climbing, and if you don't lock in your order now, you wait months or pay more. A company's technology budget for the quarter is a fixed pot, so every extra dollar it throws at scarce AI hardware in June is a dollar it doesn't sign over to IBM. And here's the piece that makes this land on IBM's exact quarter, not the next one. A lot of IBM's biggest software and consulting revenue only counts once a deal is actually signed. And those large deals tend to get inked in the final days of a quarter, right up against the deadline. So when clients spent late June scrambling for AI hardware instead of closing with IBM, those deals didn't vanish. They just missed the buzzer and dropped out of the quarter's numbers. In Krishna's own words, numerous large deals simply failed to close. IBM did not anticipate the magnitude of the shift. And, unusually for a CEO, he added plainly, "We faltered." Sit with the irony for a second. The AI boom is the biggest money story on the planet right now, minting fortunes for the chip and hardware companies. And that exact same boom is what just cratered IBM. The wave lifting everyone else knocked one of the oldest names in tech flat. Not because IBM has nothing to do with AI, but because, for one quarter, its customers spent their AI money on someone else's hardware. Same force, opposite outcome. And IBM's Memo didn't stay IBM's problem. The moment those numbers hit, other software companies dropped too. Workday reportedly fell about 10%, and Salesforce about 6% on the very same day. None of them had reported anything. Investors just took IBM's explanation. Companies are spending on AI hardware instead of software, and applied the same fear to the whole neighborhood. That's how one company's bad afternoon becomes a question mark hanging over an entire industry. And the question is bigger than IBM. If companies only have so much to spend on technology, then every dollar racing toward AI hardware is a dollar not going to the software, and services that firms like IBM, Workday, and Salesforce sell. Put both sides together, and the same AI dollar has a winner and a loser. The chip and hardware makers on one end, a whole shelf of less flashy software companies on the other, as long as the shift is real and lasting, and not just this one quarter's timing. Here's the honest part: we don't fully know which one it is yet. Remember, these were preliminary numbers, released early as a warning. IBM gives its full results and its updated outlook for the rest of the year on July 22nd. That report is what tells us whether this was a one-quarter timing hiccup, deals that slipped a few weeks and will close later, or the first sign of something bigger. But the lesson underneath, it doesn't need to wait for July 22nd. A stock trades on expectations, not just results, and a company can do fine and still fall if the story the market bought was better than the truth. If that idea just reframed how you read a headline, subscribe, because the same AI spending wave that flattened IBM is quietly deciding which giants win the next decade. And that's exactly the kind of thing we break down here. I'll see you in the next one.